I think the price you pay for something is always the most important thing. We know the things that we like. You know, if I was to say to you, which would you rather have, a 4-storey Georgian mansion in Kensington in London or a small student flat in Elephant and Castle in London, you'd say the mansion. But if I said to you, the mansion's worth £10 million, but I'll sell it to you for £30 million, and the flat is worth £200,000, but I'll sell it to you for a tenner, which would you now rather have? Ultimately, the price of things is what determines whether or not we make money out of it. They've always been the most important, and they continue to be the most important factor. I think value investing is quite misunderstood. There's disruption going on today on a scale we haven't seen for probably some decades, but we have seen disruption before. But ultimately, value investing works because of the human element in the market. It's not about the stocks themselves, the politics, the thematics, or any other aspect of the environment. It's about humans being humans. Humans becoming very greedy, humans getting very scared. That behavioural aspect is what makes it enduring. And I still think humans are humans in the market today. Lower for longer interest rates clearly do have an impact. Many people are saying that it allows you to pay a higher price for growth investments and mean value is going to be out of favour. Whilst that might be the current narrative, actually we can think of lots of markets where that's not been the case. Japan, for instance, which has had very low interest rates for decades, but where value has been a successful investment strategy. So whilst I think there is a certain amount of sense to the idea that interest rates could affect value, I don't think it's a wholly complete argument. And I think there's lots of ways that value could still do well, irrespective of interest rates staying low. I think ESG considerations are crucial, irrespective of what investment strategy you have. We've always had a very strong ESG input into our investment process. We think it's a crucial driver of returns. We are adjusting the fair value of businesses based on ESG considerations. For example, mining companies, where we think the long-term costs that are on their balance sheet to make good the land where they've been mining, where they may have put toxic elements into the ground, they have to make that good, that should be included within their valuation. Or when we're thinking about social considerations, where people haven't paid their staff enough, we adjust the profit margins of businesses. These are real considerations that we factor into all our work to try and drive better outcomes for clients.